In this video, we're going to talk a little bit about using futures contracts for speculating and for hedging. And I want to start out with a couple of definitions. First of all, let's start out with hedging. Whenever we're hedging, we're using a futures position to offset a natural risk exposure. An example might be something simple like Kellogg's, which has exposure to grain prices. If grain prices go up, that's going to cost them more to produce their cereal. Their expenses go up, their profits go down. So Kellogg's may decide to buy corn and wheat futures in order to control the price of their grains going forward. Speculators are doing something completely different. Speculator is using a futures position to create a risk exposure in an attempt to profit from that risk. For example, if Kellogg's is buying corn futures or wheat futures, that's a hedging situation. They're exposed to the price of grains, and so they're trying to lock in those prices with futures. If I were to buy corn futures or wheat futures, I would be speculating. I don't have enough risk exposure to corn prices or wheat prices to really worry about hedging that risk in the futures market. Instead, if I were to buy those contracts, I'd just be making a bet on the direction of corn prices or wheat prices. Here's a little bit more detailed example of hedging. Let's take a look at a financial institution and assume that financial institution holds several long-term fixed-rate mortgages. This creates an interest rate risk exposure because really from the perspective of the financial institution, holding those long-term fixed-rate mortgages is the same as holding a bond. And as we know, as interest rates go up, bond prices go down. Now those long-term fixed-rate mortgages are just like holding a bond as an asset for the financial institution. So now they're exposed to interest rate risk. They may decide to hedge that risk by shorting Treasury bond futures contracts. The reason they want to short those contracts instead of buy them is because their natural risk exposure is as interest rates go up, their bonds, the financial institution's assets, go down, and so they need to offset that. The Treasury bond futures will also go down as interest rates go up. Since they're short that will lead to a profit to offset their natural risk exposure. So in this situation, the financial institution now has reduced their exposure to interest rate risk in the assets that they hold. A speculating example might be that you assume gas prices are going to rise over the next couple of months. And in order to try to profit from that, you decide to purchase or go long 5 of the RBOB gasoline futures contracts that expire in 3 months. Now you may say, well, I'm hedging because I have exposure to gas prices, but not to the extent that you need to buy 5 RBOB gasoline futures. That probably covers 5,000 times or more your natural risk exposure to gas prices. So here you're just making a speculation. If gas prices go up like you think, you're going to make a profit. If gas prices go down, you're going to lose. You're exposing yourself to that risk in order to try to profit from the change in gas prices. Now, let's go back to hedging. And when we talk about hedging with futures contracts, there's a couple of things to think about. One is hedging with futures contracts helps reduce risk from areas you don't have a competitive advantage in and allows you to focus on risks where you do have an advantage. Go back to our example of the financial institution. The financial institution may feel that they have an advantage in deciding who to lend money to, their credit quality evaluations. They may have an advantage in loan processing. So those are the areas that they want to expose themselves to risk in order to try to make a profit from. Remember, businesses aren't risk minimizers. They're trying to take risk in order to make a profit. but you want to focus on risk where you feel you have an advantage. And trying to predict interest rate fluctuations probably is not an advantage for our financial institution. So they can hedge that risk and instead focus on the risk associated with initiating and holding those fixed rate mortgages. Another advantage of hedging with futures contracts is they're generally a low cost tool. The transactions costs on futures are relatively low. They're liquid assets, so it makes them very easy to use for hedging tools. Now, a little bit about the downside. While hedging allows us to reduce our downside risk, it also reduces the upside risk. Go back to our financial institution holding those long-term fixed rate mortgages. We looked at what happened if interest rates went up. That would have caused them to lose money on the mortgages that issued. But what if interest rates went down? Now they're holding those long-term fixed rate mortgages with high interest rates that were going to go up in value. They don't get that benefit because they've hedged, so they've hedged away their upside risk in an attempt to reduce their downside risk. We also run into the idea that hedging may not be a perfect hedge, or the futures may not be a perfect hedge. For instance, interest rates on mortgages may go up while the interest rate on treasury bonds may go down a little bit. Now, you're not likely to see huge differences, but you could see a situation where credit concerns with mortgages or the real estate markets make banks less eager to lend money on mortgages, pushing interest rates on mortgages up, while at the same time concerns about the economy cause interest rates on treasury bonds to go down. In that case, you will not have hedged the interest rate risk associated with the treasury bond or with the fixed rate mortgages that you'd issued. So different hedging contracts may not be a perfect hedge for the risk we're trying to get exposed to. If we look at speculating in futures, there are also a couple issues to think about. One, on the positive side, speculating with futures contracts provides tremendous leverage potential. Because of the idea of margin or performance bond with futures, typically we're putting down 10% or less of the value of the contract. That gives us 10 to 1 or greater leverage potential in our futures. So a 5% movement in the underlying asset may mean the potential for 50% or more in profits. That's a big advantage for speculators. They get tremendous leverage with their positions. Typically, liquid markets means it's easy to move in and out of those positions, so speculators don't have to worry about being stuck in a position that they can't get out of. Another big attraction is that it may help diversify the portfolio a little bit. If most of your exposure is to stocks and bonds, now you can get exposure to various kinds of commodities. There are even weather contracts that you can trade to get exposure to different types of risk profiles, and that may diversify your portfolio a little bit. Just as there are upsides, there are also downsides to think about. One, the leverage that we talked about, if the asset increases in value, can hurt us if we're long a futures contract and it drops in value. That leverage is going to magnify our losses just as much as it magnifies our gains. Now, here's a big thing, and this is why I've never participated in futures contracts as a speculator, is futures contracts are a zero-sum game. What we mean by that is each futures contract has a buyer, person that is long the contract, and a seller, person that is short the contract. Whenever the buyer makes a profit, the seller is going to take a loss. Whenever the seller makes a profit, the buyer is going to take a loss. So really, if you think about a futures contract, for every position you take, there's somebody on the other side. For you to make a profit, they lose. If you lose, they make a profit. That's what we mean by a zero-sum game. You can't both win. So you have to think about who's on the other side of your transaction. Why do you think you have a competitive advantage against them? If you're going to be trading oil futures, gold futures, grain futures, why do you think you have an advantage in determining what the price is relative to the person on the other side of that transaction. If there's no information advantage that you have, then on average, you're not going to make any money at it. You need to have some advantage in order to make a profit over time speculating with futures contracts. One last thing I want to talk about with futures is the idea of evil speculators. We hear this a lot in the news. Gas prices are high because of speculators holding on to oil futures or gas futures, and they're harming the economy. While temporarily speculators can end up influencing the price of oil, gas, or other futures related activities, in the long run they provide benefits. A couple of those benefits are, first, they provide liquidity to markets. In order to have more transactions, more liquid markets, speculators step in and take the opposite side of trades and help hedgers have the liquidity that they want to get into their positions. Speculators can also help with price discovery. Speculators are going to be quick to sell when they think assets are overvalued, quick to buy when they think assets are undervalued, and that's going to help assets move to a more fair price. So one thing to think about when you hear about the evil of speculators is to remember speculators do serve a purpose in the futures markets. They help provide liquidity to the markets, which can benefit hedgers, and they help with price discovery, which means that we get a better feel for what the true market clearing price is going to be.